Hi, everyone, and welcome back to the fundamentals of financial literacy. Today's topics are saving and investing. Let's begin with savings. Saving is easy to accomplish when there are financial goals in mind. Number one, saving for an emergency fund, which should consist of at least 3 months' worth of basic living expenses. Emergency funds are liquid savings that can be withdrawn in the face of an unexpected expense. It's very important that these emergency funds are easily accessible and hence are stored in a savings account linked to a checking account. Number two, planning for retirement and saving for retirement should be prioritized from the very start. Most financial planners suggest setting aside at least 10% of your net income each month for retirement savings in a 401k, IRA, or both. A 401k is an employer sponsored savings plan in which a portion of the income of the employee is stored in this account for the purpose of savings. An IRA or an individual retirement account is a tax advantaged or tax deferred savings account open for encouraging savings in the long term. The third financial goal could be saving for a big purchase. The sooner you start saving, the greater will be the reserve of cash at your disposal. Number four, paying off personal debts, whether that's student loans, credit card debt, or others. Paying off loans on time or ahead of schedule is advised because that can save a lot of money in interest. Number five, student loans. A student loan is a type of loan designed to help students pay for post secondary education and the associated fees, such as tuition, books and supplies, and living expenses. Student loan differs from other types of loans because number one, the students aren't required to pay off the loan with interest until after they've left school, and number two, the interest rates may be substantially lower. A student loan is money borrowed from the government or a private lender. Moving on to investing, which goes hand in hand with saving. Investing money is a good management tool because it leaves you with more money in the bank and, most importantly, with another stream of income. So, what is investing? Investing is the act of allocating resources, usually money, with the expectation of generating an income of profit. Investments can be made in businesses, in assets, in bonds, in lands or real estates, in fine art or antiques. In investing, risk and return are directly related. Basic investments such as CDs are low risk, bonds or fixed income instruments are higher up on the risk scale. Stocks or equities are regarded as riskier. Commodities and derivatives are generally considered to be among the riskiest investments. There are many investments from which one can earn. Here are the types of investments. Number one, stocks. Also referred to as shares or equities, it signifies partial ownership in the issuing company. The buyer of a company's stock is called a shareholder and is paid dividend on the basis of the earnings of the company. So essentially, shareholders sink or swim with the company. Number two, bonds. Ownership of bonds means holding a share of the entity's debt, and the owner of the bond receives periodic interest payments and the face value of the bond when it matures. Number three, mutual funds, which is made up of a pool of money collected from many investors. Mutual funds are operated by professional money managers who try to ensure capital gains for the investors. Number four, ETFs or exchange traded funds, which are very similar to mutual funds. The only difference is that they can be traded on stock exchange like regular stock. Let's wrap up investing by discussing the investment styles. Number one, active investing. best suited for the risk takers who care about short term profits. In active investing, the investor tries to outperform the market using the strategy of market timing. Number two, passive investing. Best suited for those who are risk averse and care for long term gains. Passive investors create portfolios that track a market weighted index. Tracking an index will result in reduced risk due to diversification, as well as lower costs due to low turnover. For instance, buy and hold investing is an investment style which is similar to passive investing. The idea behind it is that a stock is bought when its price is low to benefit from the price going up over time. The third investing style is called value. Value investors look for those stocks that are undervalued or out of favor, and they do so because they expect that these securities will rise and seek to buy them before they do. Number four, market capitalization. In this investing style, people select stocks based on the size of the company. There are three broad market cap categories to use in this investing style: small cap companies, which have a market cap in the range of 300 million to 2 billion, mid cap companies, which have a market cap in the range of 2 billion to 10 billion, and large cap companies have a market cap of over 10 billion. Micro caps fall under the 300 million mark, while mega caps are the largest companies by market capitalization. Small cap companies are considered to be riskier and more volatile, but they do ensure higher returns.